Hi, and welcome to the ZeroTax Zone Podcast with Andrej Kandus, your host. Tax savings and structuring is a very sensitive topic, and unfortunately one that is mostly ignored until it is too late. That's why Andrej decided to launch ZeroTax Zone Podcast. So let's jump in. What can you expect from this podcast? Well, each week, we bring you cutting-edge insights and advanced strategies designed to help maximize your deductions and save on taxes like never before. With over 40 years of combined experience from our expert tax advocates, we're here to guide you through the complex world of taxation, ensuring you maximize your savings and minimize your stress. With our expert guests and in-depth discussions, we will empower you to take control of your tax situation. Each tax situation is very unique, and I know it really all sounds so complicated, and you find yourself wondering if this is really for you, or if you can actually save anything significant, right? Well, join us as we explore the latest trends, real-life scenarios, share innovative techniques, and answer your pressing tax questions. Whether you're a business owner, investor, high-income earner, or simply looking to make the most of your finances, the ZeroTax Zone is your weekly resource for transforming tax challenges into opportunities. Get ready to take your tax game to the next level. Keep more of your hard-earned money and untax yourself with ZeroTax Zone. Welcome to this week's episode of ZeroTax Zone.
Hi, and welcome to another episode of the ZeroTax Zone. My name is Andrej Kandus, and I'm your host. And today we are going to talk about, today's going to be the second in a series of discussing the untaxable Roth method. And today is, we're going to be talking about a concept that deserves a full episode, actually deserves more than a full episode. But I'm just going to touch on this concept on a very high level to start with. And so that is what we're going to be doing. And what it is what we're discussing the potential possibility that instead of somebody that has a large deferred retirement account, meaning a tax deferred account such as a 401k, a traditional IRA account, or something of similar kind, anything that is deferred, if you don't do anything but just wait and then start drawing that account, you're going to be facing a lot of taxes left and right. First of all, you're going to be facing taxes on the distribution of any money from a deferred account. That is going to be treated as regular income. And as you probably may expect, when you retire, you're not going to have, people think that they're going to pay less taxes in retirement, but in fact, in reality, that usually happens the opposite, because you don't have so many deductions. Your house is probably paid off, your kids are gone. There's a lot of things that you had deductions before, but you don't have anymore. But it's not just that. It's not just the taxation of your distribution from your 401k, it is also then taxation of your Social Security income. This is called provisional income. The government taxes your Social Security income if you have additional taxable income. And it can be taxed up to 85% of its value, compared to nothing if you didn't have any additional taxable income. In addition, you'd be paying more taxes. Basically, it's Medicare, the medical insurance for retirees, would cost you more. It could be, up to $5,000 a year instead of, not having that expense. So, it really is worthwhile. It's worth the effort to look at options of how we can legally and ethically avoid all this, because that can result in sometimes doubling or tripling your net retirement income, which is really the difference between, having to move to a much cheaper state or a different country, even because you cannot afford to live in the same environment that you're used to. And, then you're not being able to be with your kids and your grandkids or whatever your family is around. And, you're forced to move somewhere else because of your financial situation. And we want to obviously avoid that and make it easier for you to stay where you are or where you want to be, and so on and so forth. So anyway, let's go to the main topic. So we did discuss in the last episode that we want to reposition your assets so that they have a status, they have the same tax status as a Roth IRA. Now, are we talking about a straight Roth IRA, a standard Roth IRA, or something different? We are talking about something different because it makes a lot more sense, but it has all the benefits of a Roth IRA and much more. So the concept of let's say the financial vehicle that we're using is a concept of a cash value life insurance contract. These contracts in general in the US have a special tax status. They're basically similar to Roth in terms of there's no tax on gain and there's no tax on distribution, but they have other components to them and other benefits. Because they're life insurance contracts, they do have a component of a death benefit, a face value of a life insurance contract, which is an additional pillar of money that is independent of the cash value, independent of the value of the cash account in a contract. It's a leveraged amount that is given, that is basically the core of a life insurance contract. When the insured passes away, or in a more modern contract, you don't really have to pass away. You can use the death benefit or the face value for things like long-term care, disability, replacement income, things like that. So you're kind of creating an additional pillar of money outside of the money that you're actually accumulating in the contract, that is your cash value in the contract. Now, another thing that is very important to mention is these contracts, by definition, especially the kinds that we're looking at, and we're looking at a type that is called Index Universal Life contracts. These contracts have a provision, the assets are managed within those contracts by the insurance carrier in a way where the accumulation value in the contract is guaranteed to never lose value. So it's kind of like going to Las Vegas and having this magic blackjack table where every time you lose, you get your money back, but every time you win, you get your money back and your winnings. So, the question is not whether you're going to lose all your money at this blackjack table, because you never can. The question is only how much you're going to gain every year. You just have to try long enough, and you're going to make it. You're going to make a lot of money with it because your principal is never going down. That is one very important factor with these contracts. So you have no downside volatility. Obviously, you could have, the least that you can make in a year is zero. The maximum is usually defined as well, but we're capturing about 80% of the market. The S&P is typically the index that the account is connected to. Indirectly, though, it's connected in a hedged way, so that, as I said before, you have downside protection. Because of the downside protection, because the minimum that you get is zero, the maximum is also kind of limited because of the pricing of this hedge that the insurance carrier does. But it provides enough room that we capture about 80% of the market, which is more than enough. And if we do if we do an analysis of the historical performance of the S&P, for example, the average return, if you just Google the history and you run a history for about 150 years, that average return, the average annual return is about 5%. But if you replace the minus years with a zero, which is what happens in a cash value life insurance, such as an index universal life, then believe it or not, that average is double, is more like 10%. So the importance of never losing money is huge. And the fact that, in relative terms, you can achieve double the average return, that doesn't mean you're going to have double the money. That because we have a compounding effect year after year, that could be much more than double the money available because of this, relatively double the performance. The third concept that is really, really important, and it is very much unlike a brokerage account or a bank account. Let's say in a bank account, the bank is making all the profits, right? And why does the bank, when you deposit money in a bank, you maybe get a 1% interest rate or zero for a checking account, whereas the bank may be taking that money and is lending that money out, and they're lending that money out not for 1%, but they're lending it out for 10%, right? So they're taking your money that is costing them maybe 1%, and they're reselling it technically for 10%. They're multiplying their profit. They're profiting 10 times of what you're profiting on that same money. That's why the bank is so interested in our deposits, because not only can they lend out this money, they can actually go to the Fed and get much more money based on that deposit. So why am I telling you this? Because instead of having money in a bank and have money work for the bank, so the bank makes all the profits, we turn the tables. In a life insurance contract of this specific kind, it is you who are the bank. You're making the profits. You are reselling the money, which means that the money that is in the contract is actually your collateral, and you are borrowing from that collateral. And if that collateral is earning more interest than the loan is costing you, then you're making that interest rate difference. So not only are you growing that money tax-free and distributing it tax-free in a form of a loan to yourself, you also keep making money even on the money that you've already taken out, because you have taken money out against your collateral as a loan. That's a huge factor. So no tax on growth, no tax on distribution, potential interest rate arbitrage on when you take the money out and you take a policy loan to use that money for whatever you want. And obviously, as I mentioned, the face value of the contract, which provides a leveraged death benefit from day one. So, when we add it all together, we're, with the same money, with the same cash flow, we can generate 2 to 3 times more wealth than with a similar, let's say, investment in the stock market directly, without any of these side benefits that we have in a contract. So as a vehicle, this type of a contract is a perfect vehicle for what we're trying to achieve. And so then now you're saying, well, how does this save us taxes in distributing money from our 401k plan? So we got to take a step back. I've just explained why this contract makes sense in terms of the safety and protection of your assets in general, not ever losing money out of your assets. So basically helping you not run out of money because of some market crash or something like that. But what our goal is, not only do we want to find a perfect vehicle for that, but this vehicle or a combination of this vehicle and some other vehicle has to allow us to legally and ethically enjoy a tax relief when we take the money out of our 401k or IRA. And the way it can be done through a life insurance contract is that we can design, we have some leeway of designing the contract in a way where we can accelerate the costs in the contract and we can decelerate the gains in the contract. So we have certain options that allow us to tell the insurance company, let's take a 5-year S&P point-to-point crediting method as it's called. So don't give us any credit for 5 years. We don't care what happens, from now until 5 years from now. We're just caring what happens today and 5 years from now. So we're only going to get the credit 5 years from now, which will allow us to kind of accumulate that gain in the background, but we're going to distribute the contract. We're going to take it out of the plan before that credit happens. So we're going to be taxed on the market value of that contract is such that it doesn't include that gain because it didn't happen yet, right? Whereas if we can accelerate the cost, and in any situation we accelerate, when we prepay costs, what does that do to something mathematically? When you prepay, when you put a burden on something before and less burden on something after, what is that going to do to the growth of that, let's say, pile of money? If you have no expenses, if you have expenses at the beginning, but then much less expenses later, that later time is going to be no burden. So the growth curve is going to be much faster. So in terms of long-term performance, in terms of long-term performance, and in terms of the tax basis of this particular account, we want to, if we can, we want to prepay expenses, and we want to delay the credit. So we're kind of putting pressure on this contract from two sides. From one side, it's the expenses. From the other side, we're delaying the income. And when we're doing that in combination, we can achieve a situation where your taxable basis is about 40 or 50% lower than it would be otherwise. So suffice to say, that helps us save. Even just by doing that, we're saving legally and ethically about 50% in taxes when we're taking the money out of that contract. So these are the most important concepts that I really wanted to cover today. So I kind of introduced you to this concept of a life insurance contract to kind of give you an idea of how flexible and useful it is for this particular purpose. And we're going to talk a lot more about this in the future and in future episodes. But for today, I think it's a big enough. Most people have never heard of this, or they heard of it in the context of something completely different. Most people have heard of term life insurance, which is really something that I call it's kind of like renting instead of owning, because term life insurance, it does not accumulate any cash, and it expires. It usually expires. It's basically saying, you're insured for X number of years. It's usually 10, 20, or 30 years for the same price. But then when that term is done, that policy expires. And when it expires, if you want to renew it, it's going to cost, I don't know, 5 times more for the same amount of coverage. But you have no cash to speak of. You basically have this just catastrophic situation protection, but you're not building any equity in it. So we're not talking about that. We're talking about a very, very custom designed cash value life insurance contract, which behaves and has very different rules than a term life contract. So anyway, I hope this helped today. We're going to continue the conversation and going deeper into the solution. I just want to kind of remind you that it is definitely worth your effort to educate yourself on this, because the final result after doing all this, typical results are that somebody is, when compared to doing nothing in their qualified plan, they can double or triple, or even more depending on the age, their retirement income, and they don't have to worry about any taxation going forward. They don't have to worry about taxation of Social Security. They don't have to worry about required minimum distributions. The required minimum distributions problem goes away, and they don't have to worry about the additional cost of Medicare. So all these things combined, and the power of that concept of interest rate arbitrage and borrowing against yourself and no tax and the consistent growth, is really providing that power to double or triple your retirement income for the same amount of money invested, right? So we're not talking about saving much more money in making this happen. We're talking about using the same amount of money that you had before, that you saved, and you're worried about running out of money. You're worried about taxation. You're worried about RMDs. You're worried about all this other stuff. This way, you can legally and ethically enjoy the tax relief through this concept, and you are potentially in a position to double or triple your net retirement income. Anyway, so I hope this was useful. We'll talk more later in the future episodes. Please subscribe if you like this content, and we'll be in touch soon. Have a good day.
Thank you for listening. We hope you enjoyed our podcast. We will have a weekly podcast covering everything tax-related that will help you not only grow, but exceed your tax savings. Looking forward to seeing you soon.